Hey guys, it's Willie, and today I want to take a look at Intel stock. Currently, it's trading at about $49 a share. Over the past 12 months, we've seen a decline of 15%. Today, I want to look and see if, at its current price of $49, do we think it could be a value play, and do we think that we should do more research into the company to see if it's worthy of being added to our portfolio. So let's switch over to our Excel spreadsheet and see what we can figure out by looking at some numbers. Alright, so now that we're in our Excel spreadsheet, I've put in some numbers in here, starting in 2011, going up to 2020. So revenue, we've seen it grow from 54 million to 77 million, almost 78 million, which is great. You're looking at roughly a 4% growth rate for revenue. Earnings, we've seen similar growth, 13 million to almost 21 million. You're looking at about 5% earnings growth over the past 10 years. Now over to cash flow from operations. You've seen growth there as well, from 21 million to 35 million, about 5%. Capital expenditures, I want to pause here for a second. I know I'm trying to get through this as quickly as possible. I want to pause for CapEx simply because capital expenditures, being the money that Intel spends to run their business, these numbers are likely to go up. If you've read any news or reports or whatever from Intel, they are heavily investing in manufacturing. So they want to catch up with TSMC, who has absolutely taken over as the chip manufacturer of choice for a lot of companies. Intel wants to get back in the game, back to manufacturing. So Intel is saying that they're going to increase the number of capital expenditures in the future because, let's face it, these factories that they're building are ridiculously expensive. You know, you're talking really high-tech equipment, a lot of resources, really big factories to build chips. This number's probably going to go up. How much? I don't know. I wish I could pull numbers from the future, but I don't have my crystal ball with me at the moment. Actually, I don't have one at all, but it doesn't help anyway. I can't pull those numbers. Wish I could, so just keep in mind that this number is likely to go up in the future as Intel invests in themselves and starts to build all of those factories to manufacture the chips. Alright, moving on. Free cash flow, you're looking at roughly a doubling from 10 million to 20 million, almost 21 million over the past 10 years. 7.5% compound annual growth rate. Shares, I want to look at shares really quickly, because shares are a wonderful way for a business to take its cash flows and reward their investors for being long-term investors. So if I would have bought a share in 2011, if I bought a single share in 2011, I would have had one share out of 5.4 million shares. If I just held that one share, did nothing else, held that one share, in 2020, I own one share out of 4.2 million, which means now I own a higher percentage of the business than I did in 2011, just for sitting there. I didn't do anything. That one share sat in the account, and my share of the business went up as Intel chewed up these shares. That's why we love to find companies who buy back their shares and reward their investors. Intel is one of those companies. You're looking at 5.4 million to 4.2. That's buying back, 1.2 million? You're looking at minus 2.5% every year for the past 10 years. Fantastic. Thank you, Intel, for rewarding your investors. Now, EPS and free cash flow to equity, we're just taking the earnings and the free cash flow, dividing it by the number of shares. That's why this number seems to go up so quickly, is because not only are the earnings and free cash flow going up, but the shares are going down. So you're dividing a bigger number by an even smaller number. See what I'm saying? So you're dividing a number that's getting bigger by a number that's getting smaller. And so the number ends up being bigger, which is why you're seeing the 7.5 and 10% growth rate of the earnings per share and free cash flow per share. It seems a bit big, but that's the way it is. It just seems to be big because of the way Intel is chewing up their shares. Alright, so now, total debt. We take total debt, we minus the cash, because if the bank calls and says, hey Intel, we need our money, Intel says, okay, here's the cash. We'll pay that immediately. And they're left with the net debt. So total debt, pay off the cash. Now we've got our net debt, what's left over. That has gone up. I don't like that a whole lot. But I think with Intel being such a big company, you're looking at Intel needing to raise debt to kind of push forward, earn those returns, do what they can, reinvest. I mean, again, the factories are really expensive, so they need to borrow for this stuff. So it's gone from 10 million to 48 million, 16.6% a year growth of debt. That's high growth. I don't really like that. But, however, Intel has kept it under control. So if we look back at our free cash flow, that is about 21 million. Net debt after cash for 2020 was 48 million. So you're looking at, what, 2.5 times free cash flow to net debt? So if they were to take all of their free cash flow and throw it at debt, it would only take them 2.5 years to pay off everything. No debt whatsoever. I'm talking short term, long term, everything. They would have no debt in 2.5 years if they threw their cash at it and then kept throwing all their free cash flow at it. Be done in 2.5 years. Really great. I think that's safe. Nothing to worry about there. ROIC, this is the return that Intel is earning on its money that it's investing. Alright, so you're looking at, roughly 20? Say around 20 ROIC for Intel. Really good. Really great for Intel. I really kind of expect it from somebody that is doing such high-tech work and such a needed thing. I mean, everybody needs chips now. I think we've seen that with the shortage. Everything needs chips. Everything has chips in it. Intel is the guy making all the chips. So, yeah, really good return on invested capital. Let's slide over a bit. These are some metrics that I like looking at. So your PE tells you if it's cheap. It's good, looks like it's cheap. Price to free cash flow looks like it's cheap. Net debt tells you if debt is safe. Debt looks like it's safe. 5-year revenue growth looks good, it's positive. Earnings growth, positive. Free cash flow, positive. Shares outstanding going down, great. Return on invested capital looks like it's great. Now, I want to flip back, and before we go to our forecast, I want to talk about the free cash flow again, because that is part of our forecast. As you can see, I've got a 7.45 compound annual growth rate for the free cash flow. I want to say first, look at here. Okay, we saw a big jump between 2019 and 2020. If we remove that, we had the shortage, we had a lot of crap happen. So if we kind of remove this fluke, you're looking at, if we remove this, the 20, and do it based on these numbers, from 10 to almost 17, you get about a 5% growth rate. Okay, so with that out of the way, let's flip down here. So I haircutted the 5 from the earnings. Earnings was about 5, and free cash flow was about 5 after we got rid of the big 21 up top. I haircutted that down to 3. Alright, and then you forecast this out, you end up with $6.65 in free cash flow per share in 2030. I assign a price to free cash flow multiple of 15. I think that's reasonable for such a big company like Intel, who is doing some pretty necessary stuff. So now you're looking at a stock price based on free cash flow of $99.70. Did the same thing with earnings, grew it at 3%. You're looking at 6.64 in 2030. PE, I assigned a 15 multiple, just like price to free cash flow. You end up with a stock price in 2030 of $99.55. All right, so here we are over to our mix here. We're looking at $49 a share right now. We came up with our price targets. I'm going to split the difference, come up with a price target of $99.63 per share for Intel in 2030. Now I'm going to go over to the IRR calculator. So we're in at $49. We're out at $99.63. These are our free cash flows over time, which are ours as part of our being a shareholder. The free cash flow per share is ours because we own the share. So you get this stream of cash flows, and you come up with a IRR of 19%. You're looking at a 3.23x your money over the next 10 years, which is above market. I would expect the stock market to do, 10% over long term. Frankly, over the next 10 years, I think it's going to be lower just because of the amazing returns that we've seen. I want to flip back. One more exercise I want to do is say, okay, let's assume that everything goes terribly wrong. We are wrong. Everything goes terrible. Intel just doesn't grow at all. How bad does it have to be for us to just get a market return? Okay, so let's say that Intel grows free cash flow at 0%, and let's carry that over to earnings. So earnings stays the same, and free cash flow stays the same. Now, you end up with a $74.13 price target. Again, you can buy it at $49. If we switch over to our IRR, you're still looking at 15%, which is above market. All right, let's flip back. Let's say they decrease at 2% a year. Let's pull that down. Let's copy it over to our earnings. Let's see what that looks like. You're still a $60 price target. You're still looking at a 13%. So I think, if we keep doing this, saying, all right, -4, -6, and so on and so forth, and just keep going back and forth, saying how bad does it have to get before we really lose? Even if Intel starts losing money at 4% a year over the next 10 years, you're looking at a 10% return, which matches the market over time. I think that would actually beat the market over the next 10 years. So, is Intel looking like it could be a good value play? Yes. It looks like Intel could be a really good value play. I think it looks like it's cheap. If you do the math, again, this is just a math exercise. I think Intel looks like it's a really good buy from this standpoint. As always, do your due diligence. Go through the balance sheet, cash flow statement, income statement, read the reports, read the news, see what other opinions are. Come to your own conclusions. I always advise people, do your own due diligence, and then decide for yourself whether or not you want to buy the stock. Don't just believe somebody on YouTube telling you this stuff. Don't believe us at all. Do your own thing. Do your own numbers. Come up with what you think. But from what I'm looking at, I think this could be a really good stock to do a little bit of a deeper dive on. Do your own due diligence. I think it might be interesting. Might be a good add to the portfolio. From a value perspective, I think you could definitely beat the market. Again, if you're looking at -4% over the next 10 years, and you're still looking at a market return, I think Intel is a great play at $49. Right now, I think it's great. I think it's wonderful. So, that's been Intel. I think is a really good value play. Thanks for watching. Like, comment, subscribe, all of that good stuff, and I will catch you guys in the next video.